Hey there, YouTube. If you did not watch the other video that came out right before this one, how to day trade simple, go watch it first. Because I'm not going to go through all the indicator setup you see here. It's very simple though. And we're gonna go on one example of one trade, which was this negative 1,000 New York Stock Exchange tick prints on the mid of prior session range at 6:08. This was at 1:40 p.m. Eastern time. We're looking at XSP. So in the other video I showed you SPY. Today on this video, I'm going to show you XSP. Couple things. XSP has been becoming more liquid and it is cash settled. If you do not know the difference between cash settled and shares settled, European versus American style options, very simply, cash settled should be apparent what that means. It means by expiration, all of the options that you have when they're assigned or exercised, it's all in cash. No shares. You cannot buy a share of XSP. It's just cash. If you've been trading SPY, like the ETF, especially 0 days, if you're doing spreads, there's some risk there. When you sell short a put or a call, there is assignment risk of 100 shares of SPY for every contract sold short. We're going to do XSP. I highly encourage anybody, if you're trading, if you're doing anything like this, just do XSP. It's a lot simpler. Also, Webull, Robinhood, tons of other brokerages that I can think of. Those two specifically for sure, though. At 3:30, they close you out on QQQ, SPY, the IWM. If you're in a 0-day option, 3:30 comes around, they close you out. So that's no fun. You don't get to see your idea work to the end of the day. So that's what we're looking at here. This is the trade of the day. One trade, one opportunity, rules-based, negative 1,000 tick, key level. We're ready to go. We invert the tick. What does that mean? Bear tick down here, we buy. Bull tick on key level, we sell. Here is a buy. Right here, 6:08, 1:40 p.m. What do we do? Okay, got a couple different options. Because of the movement that I typically see, we can capture anywhere from $2, $2.50. It depends. It floats on SPY's average range. So you can go look at, if we want to go look at a day chart here, let's go look at the average true range. So like $6. Let's just call it $6. I think it's probably skewed because of all the movement we've had. Okay, back here it was like $5. Yeah, it moves around. We're going to say $4 because I'm trying to be conservative here. We're going to aim for like $2 of that move, $2.50 if we're lucky. So we're bullish here. We want to buy something. Do we buy a call? We could. We could buy a call. Let's just pretend this is the current date and we're going to buy a call and we're going to buy it at the money. All right, we're going to buy it at the money. And what did I say? Like 140, okay. Doesn't matter, we got like 2 hours remaining. This is going to be close to what it would look like. It's close to what it would look like here, and we're risking, what does this cost us? About $1.70, let's say, and delta 50 to, let's call it 50 deltas. All right, 0.5 delta, 50 cents for every dollar XSP moves. XSP moves $1, you make 50 cents. If it moves $2, you make $1. It scales, so it's not exact science there, but it's a good rough estimate. So that's nice. If you're holding this to expiration, which you can do because it's cash settled, you actually need to beat the premium that you spent. So you say 609 call. Okay, so you need XSP to move to 609. Okay, great, it's at the money. You're already there. You bought it. But you actually need to account for the premium you just spent, which is another $1.74. So what is 609 adding $1.74? Well, it's 610.74. So you don't need XSP to move to 609. You actually need XSP to move to 610.74. That's just a break even. You're not actually making money. You just recouped the money you spent originally. at 1:40 in the afternoon. All right. So that's a lot going against you. What if there's another way? There is another way. You can do a spread if you have margin enabled and you have spreads. I believe it's level 2, could be level 3. It's been a while since I've applied. Either way, it's not very difficult to do vertical spreads to get approved for that. So we're going to sell a call. We're going to sell a call higher up than our 609. Okay, we're bullish. We want calls. We're bullish, and we're just capping our max loss. Okay, so without this, our max loss is 174, and our max profit is infinite. But that's BS because we know XSP moves about $4 a day. All right, so $4 a day, 609. We're halfway through the range, so we can really only expect about $2. That's not very good. We might make like $20 here. Okay, it's not real good for the amount of risk. We're risking 174 to make $20. That's not good. Not to mention the delta is telling us we only have, it's a coin toss basically. It's 50-50. So how can we fix that? We sell a call against this. We're going to sell the 610. We're going to sell it against the 609, and since it's higher, we can make money past 609 until 610. Okay, now look at our max loss. $58. That's not bad. We reduced our max loss by $120. Now we did cap our gains, but we doubled our gains if you factor in the usual movement. We're halfway through the range on this theoretical, well, on this day, but of course we're looking at contracts for tomorrow, but we're pretending. And we know it's probably going to move about $2. All right. So we only have about $2 to play with here. So look at this. We're at 609. Our break-even point is 609.5 because we only spent $58. That's awesome. So 609 plus the 58 we spent, our break-even point has been reduced by $1.20, right? However much we reduce our max loss, that shifted a break-even point back in our favor. All right. Now, if we get to 610, which is theoretically possible because prior day range was 610, the market's already been there. That's not that hard. All right. That's pretty reasonable. If we get that, look what we make, $41. Versus the other trade, we take this back out, we lost $72. Okay. So this is one thing you could do, a bull call spread. Fantastic. Completely shifts the odds. Now, we closed at 609 and change. So if we pretend, we lost 15, $16, maybe $20. So it's not too shabby, right? At some point during holding this trade, it may have been profitable. This curve's not going to show us. Unfortunately, I don't have the tools right now to show you, but a lot of times, just this move alone, you might have actually made the theoretical max profit and you could close it out, maybe minus a couple bucks. All right, just like if you buy a single leg, just a call or put, oftentimes it's profitable, but if you hold it all the way to expiration, you lose money. So it's really no different. The nice thing about this is we define our risk. We can walk away because it's cash settled. We can just walk away. There's nothing else you need to do. This is the second part of keeping trading simple. So what else can we do? Maybe we're not very confident on the upside. We just know and we're confident that the tick is going to be inverted. The market is going to respond to that bull tick or bear tick and say, "Whoa, that was too aggressive. You're going to go up now. We're gonna buy some stuff." So great. Maybe we don't care. $2 up. Maybe it can just chop sideways. We don't really care. What can we do instead of buying calls? Debit. Maybe someone could pay us to trade. That sounds fun. Somebody's going to pay us for their trade. It's called selling a put. Okay, so here we can just sell a put. As long as you have the correct account set up and approvals, you can receive $102.05 for selling a 609 at the money. Again, we're pretending that we were at 609 here today. What's not fun is the max theoretical loss is $60,000. That seems a little ridiculous to risk $60,000, let's call it $61,000 to make $102. That's no good. Something could always happen. Now, margin, maybe you're only using 12K. It's going to be hard to scale this on a smaller account. So what can we do? If you guessed buy a put, congratulations. That obviously reduces your credit. Somebody paid us when we sold this put. We're going to use some of that money, that we're going to use some of that sweet Chiba here, $102. And we're going to buy with that money, we're going to buy ourselves protection. We're going to buy ourselves some protection, and it's going to look a little different. So we were 50-50 on the calls that we bought as a debit. A little more difficult oftentimes to get 50-50 as a seller. It's not impossible. It's usually more like 40-45 credit for 60-55 max loss. It's still great because, again, we know that per the average range, we're looking at about $2 possibility this way. We also know that the market just had an aggressive move that's probably going to be inverted. It oftentimes is. So we can sell puts. We'll sell a put to some schmuck over there on the other side of the market. And, we're gonna give them the opportunity to be right. And in exchange, we're gonna accept their sweet Chiba. And then we're gonna buy ourselves a little protection. And look at our break-even point. Our break-even point is 608.71. So if this were the 609 per example, then 609 minus another 30 cents or so. So it'd be down here somewhere. So we have even more room to be right versus a buyer still needs a little upside. A seller is already there. We're already where we need to be, which is fantastic. If we're wrong, yeah, it's not fun. But yeah, that's the price you pay to shift the odds in your favor. So when we sell, it's 46% chance for the, I don't really trust this delta. A lot of times these deltas are a little off after hours. But, the delta is 46% chance for the buyer to be right. All right, and a 54% chance for us to be right. Now, of course, that's just that leg. If we add this in, it changes the whole thing. Either way, the odds are higher in the seller's favor. So you can put this on. Let's see if this was 609. 609, it only moved $1. Great, right? We're full profit, $30, probably more like 40. Versus, again, if we bought a call, sold a call, and we only moved $1 from where we're at, we broke even, maybe lost a little bit. So that's the big difference between being a buyer, spending money, being a buyer for a debit, versus being a seller for credit. You're not actually spending your own money. That's exciting. You're using other people's money, OPM. So that's another way to do this. It's another way to do this, and it's the way I prefer to trade. Selling counter to where I think the market will go based on tick. So that was one trade, and this is primarily what I do. So like here's another one. Look at this one. This was just the other day, June 23rd, Monday, and we got 1200 tick, key level, prior day low, sold puts. What happens? We we freaking eat like $5, $6. Oh God, yeah, $6. Okay, those puts are worthless probably by about here. They're worthless. Buy them back. They're dirt cheap. Close your trade out. You're done for the day. You could say sell calls here. Maybe you sell calls here. You take a small 20% loss. You're probably still profitable between this trade and that trade. Okay, but really, one and done. Keep it simple, But you could do multiple trades. The closer we get to the end of the day, the more hairy everything becomes. The credit is not going to be as good. And if you want to be a stickler, you want to wait for a wick pierce here, as I call them, when these wicks pierce the key level and then come all the way back. That's beautiful. It's a beautiful thing. You had 10 minutes of opportunity to enter here. Set an alert for tick and just wait. And you get so much time, and you can set your price. That's the other great thing. I mean, you could do it as a buyer as well, but as a seller, you can say, I'm only willing to give this opportunity to somebody for 50 bucks, 40 bucks, whatever. Okay. And the great thing is you're not really trading from here. That's your signal. You're actually trading more like an extra 50 cents, a dollar below. And yeah, these opportunities are always present. Okay. So here we had another one. This one's a little weaker on the tick. This one also not really a wick. So maybe you don't take this one. It's already kind of at the low of day. I'm not really a big fan of shorting the lows. So maybe this was just a no trade day. I really like this one here. I just don't like the fact that it's right at the open. It's usually a very volatile time, and we weren't really near a key level. So it's not really trades there. This one here, FOMC, set your price. Okay, we didn't really come up. So this is where a put seller would have won out over a call buyer. Even if you use a debit spread, put sellers made full profits, call buyers probably broke even, lost some money. So it just shifts the odds greatly. Here's another wick, prior day low, not as aggressive. So either, maybe when you're just starting out, ignore this one. But once you become more comfortable with this style of trading, maybe you're running like 3 typically on these kinds of trades, 3 spreads. Maybe since this one's already at the low a day, maybe you only do 1. So you can adjust your scaling. But let's just keep it simple and just say you skip, or you just do it, whatever. These opportunities are here all the time. This trading style plus XSP is like the best way to learn spread trading. Even if your plan is to swing trade spreads, just learning the mechanics, learning how to assemble them. You could paper trade. You could run these with real money, 0 day. The risk is really tiny, and since they're cash settled, there's never any risk of assignment. There's no pin risk, horrific stories that you may have read. It's very simple. That's it. This is the second part, and that's the only other part that needs to be made because it really is simple. You're waiting for tick extreme on a key level. That's your job is to wait and snipe key level wicks with tick confluence. Do that. Comment on this video and tell me what's going on. I also have to say, none of this is financial advice. I'm merely sharing a strategy that I have been doing this year, especially really honing in. I love XSP. It keeps things nice and small for experimenting on all kinds of different things, and it's become a lot more liquid this year. And so for me, I don't think trading necessarily should be fun. It's not a bad thing if it is, as long as you're not gambling. You're taking appropriate you're employing appropriate risk management techniques. But for me, it's enjoyable. It's fun to wait for these ticks. Snipe the entries. I hope you learned something here. Keep it simple. You don't have to trade every day. One thing, wait for the same thing every time, and execute the same way every time. Comment on this video. Tell me what happened. And yeah, as always, thanks for watching. Happy trading.